Hello there, everyone, and welcome to the latest edition of our Market Misbehavior podcast. I'm your host, Dave Keller. Our goal with this podcast, as always, is to illuminate the markets by talking to some very smart people, talking to top market practitioners, analysts, strategists, money managers, and anyone else we can have a great conversation with. Today, one of my favorite market analysts and strategists, someone who's become a good friend as a fellow stock charts contributor, Tom Bowley, the chief market strategist at earningsbeats.com. I met Tom years ago when we both were contributing to stockcharts.com. I've gotten to know Tom over the years. He has a great background as an accountant. He was a CPA in his former life, then eventually transitioned to become a technical analyst. So he has that rare combination of a deep understanding of balance sheets and cash flow statements and so forth, but also charts and momentum and trend. And looking for good companies with good charts is a tried and true approach to investing success. And I think Tom, in a short conversation, provides just a mini masterclass on how to do that. I love some of Tom's long-term charts, looking at trends in the S&P 500 and the Nasdaq, looking at mean reversion and how really off of the 2009 low, while the market has had surges to the upside and corrections to the downside, overall it's been a fairly consistent primary uptrend, a secular bull market. It could provide us some insights into what to expect going into the beginning of next year. Talked a lot about small caps, which have been performing better on an absolute basis, but still underperforming on a relative basis. Tom, I think, had some really interesting thoughts about the interest rate environment, Fed cuts going into 2025, how that could provide a great tailwind to small caps, which is an area he's particularly bullish on. We also talked about the different portfolios that they put together at earningsbeats.com. We highlighted his aggressive growth portfolio, and he shared one of the names that recently came up on their screen. Talked a lot about stock selection and how to think about big picture investing themes, but also looking for actionable ideas, again, that demonstrate earnings growth and earnings potential, but also strong technical configurations. So enjoy what I feel was a fantastic and thoughtful conversation with Tom Bowley of earningsbeats.com. So super excited today to sit down with Tom Bowley of Earnings Beats. Tom, good to see you again. Happy holidays. How are you these days?
I am doing well. It's been a great holiday so far. Looking forward to 2025. I hope everything's been good for you and your family.
Things are good. No complaints. I would say market-wise, very few complaints as well. I follow your work pretty closely as a fellow stock charts contributor. I think you've pretty much been on the right side of this fairly consistent bull market in 2024. When you're sort of looking back at this year, I mean, how do you? I guess first question: any surprises? Like, did this surprise you in terms of the strength and consistency of the uptrend that we've experienced in 2024?
Yeah, I think there was one really big surprise. I thought historically, most years, and especially presidential years, we tend to see big struggle in the market around August, September, and into October. And we did have a little bit of weakness. We had that big drop, especially on the small caps, beginning of August. But we came out of that August 5th bottom, and I mean, it's been straight up with hardly any pullbacks whatsoever. And so for me, that was really surprising because in presidential election years, particularly, we do see weakness heading up to about a week or maybe 2 or 3 weeks before the election. And then things pick up and we go very, very strongly into year end. And I do think, seems like we're getting that part right.
And I feel like post-election, at least in my perspective, there was so much optimism kind of baked into the markets going into elections. But then after, it's all, I mean, we stepped on the accelerator, sort of thinking, all right, maybe it's all been priced in. Trump victory, surprised, I think, many. And it all, I think some would have thought, all right, well, maybe that was it. Maybe we did all the increase beforehand. But it's just sort of, we've just sort of stomped on the accelerator going into UN. So I mean, just looking at the overall conditions, and then we'll get to some charts. I mean, I would imagine you're still constructive based on the general trends, or do you see signs for concern here?
No, I we'll have temporary short-term pullbacks. I mean, you really can't avoid those, but I don't see anything big to take us down right now. Most of the signals I follow are very, very bullish. And so I'm continuing to maintain, my similar stance. So, the one change that did take place quite a bit right after the election was the big drop in the volatility index. We were up at 23 or so, and that had me a little nervous. Anytime you get the VIX above 20, I think you have to at least be aware of the possibility that things could turn ugly very quickly. It's a sign that the market's very nervous. And so I think once the election, was over, I mean, there was literal, I don't know if it was 20% drop, I think the next day after the election. And the VIX now has worked its way all the way down to 13. And historically, that means really good things for stocks when you've got the VIX down this low. So I think we're full speed ahead, but I do think that we may play catch up in some areas.
Yeah, we're on the same page, I think, generally speaking, Tom. And I would totally agree. Our last episode of the podcast, we talked with Russell Rhodes, who wrote a book about trading the VIX, and similar idea. I mean, the volatility where it is pretty consistent with sustained bull markets. It's sort of a wait for a spike in volatility, but we're not seeing it certainly this week, as you mentioned, kind of back in the low teens, kind of the lower end of the range we've been for the last couple of years. You sent some charts ahead of time, which I'd love to go through with you. And a couple of these are more longer term charts, really looking at the trends in some of the major indexes. Can you talk through a couple of these and we'll sort of get a sense of where we're at relative to where we've been?
Yeah, so this chart that we're looking at here, this is the S&P 500, and it really goes back to 2009. But as far as I'm concerned, the secular bull market began in April of 2013. That's when we took out the highs from 2000 and 2007. It would have been a big mistake to go back to the low in 2002, thinking that was the ultimate bottom. 2007, we came right up, challenged that prior high. I think maybe eclipsed it barely, and then went right back down to new lows. So, a lot of folks will look at that low right there and say that's when the bull market started, but you really didn't know for sure that we were going to get the breakout. So I understand that line of thinking, but for me, it doesn't really confirm until we get the breakout, which we saw in April of 2013. But if you connect the low from 2009, that's a massive low financial crisis, and then connect the other low of the 100-year pandemic. We don't see those come along very often. That to me is a longer term support line in this uptrending channel that we have here. So what I did is I took that bottom uptrend line and I dragged it up to the top to connect the highs. And for me, not too surprisingly, but you can see that connects most of the tops, except for late 2020 or late 2021, when we kind of had a little overshoot outside the trend channel. And to me, that was one of the big warning signs back in late 2021.
I love this. And you're bringing up a painful lesson for me personally. I remember vividly being bearish in 2013. I think I became a trend follower at that time because I remember going bearish thinking, all right, I've seen this a couple times, no problem, we're at the peak. And then the market just went higher and just kept going higher. And I'm sitting there watching it and thinking, there seems to be a good approach here, which involves following these trends as they go up. So following your sort of line of thought, and I think this is a brilliant long-term chart, Tom, when you look at where we're at now, does this cause a little bit of hesitation, the fact that we're now at the upper end of this channel and maybe we mean revert at some point?
Well, yeah, I mean, if you see most of the pullbacks in many of the cyclical bear markets that we've had over the past, 12, 13 years, they've tended to occur when we've gotten up to this upper channel line. And so, I mean, we're right up against it right now, just maybe a little shy of it. So, I mean, when we look back to the period from 2013 to 2015, we kind of rode that channel line for a while. I think it might be more of that, where maybe value comes back a little bit. And, you don't see the big jumps when value is leading, like you see when growth stocks are leading. And so I think maybe we see a little bit more of that and we just kind of hug that channel line. But if we start breaking above that channel line, I mean, I think that's one of those secondary signals that would at least have me on alert, thinking, looking for other signals that might corroborate a possible top.
It's really interesting. And again, what happened as we rode the upper end of the channel, kind of the pace of the advance slowed down a little bit, right? It's a bit of a leadership rotation, I would say. Let's look at the Nasdaq, and then I know we have small caps as well. What looking at this same long trend channel, what do we think about the Nasdaq?
Same concept. I think we pulled back a lot further in the 2022 cyclical bear market. You can see we actually went all the way back down to that bottom of the channel, which I think has allowed us the kinds of returns that we've seen since the beginning of 2023. And that's one of the reasons why I think the Mag 7 did so well. I mean, it's hard to believe, but NVIDIA was trading down in the hundreds back in October. This was pre-split, by the way, 10 for
Right.
1. I mean, it was
Wow.
trading at 100 and went up to 1,200 during this period. Now it sits after 10 for 1, which went back to 120. Now we're back up in the 140s. So, I mean, this, NVIDIA has been one of those stocks that literally has almost grabbed the market on its shoulders and carried it to the upside. But many of the other Mag 7 have done it as well. But here I do see a little bit more room to the upside before we hit what I would consider a little bit more of a frothy area for the market. And we
Yeah.
just saw many of these Mag 7 stocks growth. If you look at the large cap IWF versus the large cap IWD, which is large cap growth versus value, that just broke to about a 4 or 5 month high. So we're starting to see some strength in some of those Mag 7 names again, namely Apple, which is now broken out to an all-time high. Amazon has done the same thing, Meta, and you got to throw Tesla in there. It's not an all-time high, but it's had a huge run of late. So those are 4 stocks that I think are really helping to carry the Nasdaq right now.
Small caps, on the other hand, the clear laggard compared to these first 2 indexes. What do you see about the current configuration? What does this mean about potential outlook for small caps into next year?
I love small caps. I've been talking about small caps really throughout much of the year. I talked about them back at the beginning of our Market Vision event that we do at the beginning of every year. And I said when the Fed started to cut rates, that's when I thought we could start to see movement to the upside in these small caps. I was a former practicing CPA and no longer practice, but I audited banks, small banks in particular. So I do have a lot of fundamental knowledge here too. And what we've seen, you can see on the chart, the IWM is broken out now to an all-time high, which it struggled over the last couple of years. While the Nasdaq and the S&P 500 were having parties, IWM was still in this uptrend, but it was kind of hugging that middle line and not really, hasn't been outperforming, obviously been a big underperformer. And I think the conditions, the economic conditions with the Fed cutting rates and the inverted yield curve probably uninverting in 2025, I think that creates wider spreads, larger net interest margins for small and mid-sized banks. And when they start making more money, they lend more. And of course, most of their customers are not Apple and NVIDIA. They're the small and mid-sized companies, that could really drive the IWM and the MDY. So I'm a fan of the small caps and mid caps. I think we've got not only the technical conditions showing the breakout, but I think the fundamental conditions set up for these 2 groups as well. And you can see there's a lot of room to get to the upside, which is why I made a pretty bold call on the IWM. But I think within a year, we could see 400, and we're at 240.
Wow. I mean, it's an aggressive target, but if you think about the trajectory of these indexes going back to 2009, it's not unreasonable. I mean, that would actually be pretty consistent with the long-term trend that we've seen. Now, a big part of what you just mentioned, and I would 100% agree with the upside potential for small caps, given sort of a change in the shape of the yield curve. Can you talk a little bit about what's happened with interest rates? And again, given your background, what is this sort of change in Fed policy, the rate cuts? How does that fit into the trends and maybe small cap outperformance going into next year? Tell us a little bit more about what that might mean.
Well, I mean, the Fed now has they announced back in September that they were shifting policy from being much more hawkish to being more dovish. And they followed that up now with 2 rate cuts totaling 75 basis points. I believe it's just starting. And I think the thing that gives them the room to cut rates is the fact that now inflation is back under control. So when you look at the longer term or longer part of the yield curve, like 10-year Treasury yield, what we typically see is that the yield goes up for a couple of different reasons. One can be a strengthening economy, but the other can be a fight against inflation. Because anyone holding a long-term bond, like a 10-year, is not going to want to sit there with a 3 or 4% yield if inflation's running at 6%. So they're going to sell because of that. That's what's going to drive rates up during an inflationary period. But now that the inflationary period has come to a halt, or kind of, certainly we've rolled over, and I think the Fed now is comfortable that it's a sustainable move toward its target. I think now what we're seeing is that the 10-year Treasury yield is remaining up, but it's remaining up mostly because of economic strength or the anticipation of further economic strength with rate cuts ahead. which makes perfect sense to me. So I think the Fed's going to have a balancing act in 2025 and going forward. I think they're going to continue to lower rates to try to spur economic activity, but not to the point where it starts to drive inflation higher again. And so that remains to be seen exactly what that, how many cuts that means, how far they cut. But any cut, in my opinion, is a cut that will benefit small caps and mid caps because of that net interest margin that they experience at their, in terms of profitability. I mean, that's their Apple sells phones, but banks, they make loans, and it's the spread. When the rates come down, when the Fed funds rate comes down, that allows small and mid-sized banks to borrow at much cheaper costs. And at the same time, if you got a decent economy, you can lend out money higher. And so that spread grows and all that money drops to the bottom line. They become more aggressive. And I think also one thing that'll benefit banks heading forward is deregulation. I think under the Trump administration, I think we'll see much less regulation, especially on the smaller and mid-sized banks. And I think that'll be another good thing for that area.
Yeah. So when you look at the underperformance of small caps, I think a lot of people sort of generalize about, it's just smaller, riskier companies. But if you look at the sector weightings, it's really more geared towards things like financials, which are kind of underweight in the S&P, right? So, I mean, just the conditions have not been great for regional banks. The fact that they've done what they have, despite rates being what they have, is probably a minor miracle. But if it all of a sudden becomes more of a tailwind, I could see that argument that small caps start to rally. When you think about positioning now going into next year, or just where you find opportunities, is it more focused in small and mid caps than you would have been in 2024, given the strength in some of those mega cap growth names, or how are you thinking about positioning now going into next year?
Yeah, I mean, I'm obviously a huge fan of the small caps and mid caps going into 2025. I've been a big fan here in 2024. I mean, we have at Earnings Beats, we have a couple of different portfolios, it's more educational for our members. I mean, they're certainly more than welcome to trade them. They can buy them and hold them, whatever. But what we try to do is illustrate ways that you can beat the S&P 500. And so we rely on certain themes. And right now, one of those themes is small and mid cap stocks, that we want to be a little more aggressive in those areas. And what we've seen here over the last 2 months has been an absolute explosion in our aggressive portfolio, which, by the way, did not perform very well for about 2 or 3 years while the IWM and the mid caps were, languishing. But now that area of the market is rolling, we're starting to see a lot more cream rising there to the top. And even though the Russell 2000, even if it goes up 30%, I think it could go up 70%. But even if it goes up 25 or 30%, think about the leaders and what they might do. If you can find some of the best performing small cap companies, they'll grow up and be mid cap companies before your eyes.
Right. And that's one of the funny things about looking at small cap indexes. And I know, having spent some time sort of breaking down the benchmarks, like the best names kind of graduate out of small caps. They become mid caps. They eventually could become large caps. And that's happened obviously many times in market history. Talk to us a little bit about some of the growth leadership names, right? As you mentioned, Apple, Meta, others kind of breaking out. Apple is a chart I brought up, and I hope this is okay. I actually found in my stock charts login a chart style that I actually called Tom Bowley stock. So I'm assuming this is a chart you either sent me or it probably looks comfortable enough that we could use it, I hope. But if you want me to tweak it, let me know. But, looking at Apple and Meta in particular, these are stocks that had kind of stalled out for a little while. Now Apple kind of reinitiating and breaking to new highs. Same with Meta. Are these, with these names in particular, signs for optimism going into next year? These are kind of things that you would be interested in following. What's the outlook for names like this? Obviously, huge weights in the benchmarks, right?
Yeah, actually, I got a really good question from a member the other day. We have a live trading room we do every Wednesday, and the member, I've been talking a lot about small caps, and the member came in with a question and said, I find this an interesting fact that if you take the Mag 7 as a group, they've actually outperformed the IWM since August, since September, since October, and since November. And of course, I keep talking about the small caps. Now, the thing is, when you're talking about the Mag 7, you're talking about 7 of the best companies in the world. So we're not talking about the entire Nasdaq. We're not talking about the S&P 500. We're picking out the best, best companies. So I don't know if that's a fair comparison for the IWM to compare against those companies, because I still think they're going to go higher. Apple right here breaking out. I mean, when I look at this chart, first of all, if you go back down to one of the lower panels, not the bottom one, but the next to the bottom one, that's the Apple chart, or Apple relative to the computer hardware space. And if you
Yeah.
look starting at about beginning of August, for the next few months, Apple went sideways, and so too did its relative strength. But it's just now breaking out. And you can see in the top panel that we actually have the AD line, the accumulation distribution line, breaking to a multi-month high as well. So I see this as a company that's being accumulated, that has just made a breakout. And I think that bodes for higher prices. I don't know that Apple's going to go up 70% in 2025 because it already carries such a huge market cap. But I could easily see another 20, 30% in Apple. That wouldn't surprise me at all.
Another name that you mentioned, and I think this was part of your was the aggressive growth portfolio, the model portfolio. I think that you mentioned was ALAB, Astera Labs, also in the technology sector. Can you talk a little bit about this name, maybe as an example of what draws you to stocks like this?
Yeah, well, it all starts with earnings. So I'm fundamental. I came up again as a practicing CPA, so I've never really gone too far away from the fundamental side of things. But I know from valuing companies that there are two things that really drive stocks: interest rates and earnings. And so when earnings are beating and you've got analysts that are raising estimates, that's one thing that's going to drive valuations. The other thing that's going to drive valuations is lower interest rates. And so we've got an environment, I think, in 2025, which is going to cater to both. And so, you look at the thing that drew me to this stock was its earnings report back at the beginning of November. We actually added this stock. In our portfolios, we take our stocks and we reinvest every 90 days. So it's kind of a combination of trading and buying and holding, but you're only doing it for 90 days through one earnings cycle. And then you look at the earnings reports, and then you come up and you try to put together the best stocks again. So ALAB here, you can see at the beginning of November, made that huge jump. They came out with tremendous earnings, revenue, earnings per share, way above expectations. And then it pulled back, and you notice we actually get into our portfolios February 19th, May 19th, August 19th, and November 19th. And so right around November 19th, ALAB had pulled back right to that gap support, the top of gap support right there.
Yeah.
And so we were able to get into it at a time technically that I really liked it. And then fundamentally with the small caps, just believing that they're heading higher, this was kind of a no-brainer for us to add in. And so, yeah, I mean, it's had a great run so far for us. And I'm hoping next couple months are solid. Maybe this will be a double or maybe even a triple, who knows? But it's those types of runs in just one or two, three stocks that can carry a portfolio. And so those are the types of stocks that we look for.
I love it. And this sort of checks all the boxes, right? And, better earnings, improving trend, sort of a tactical pullback to potential support. I like the setup. I love the example. Just to finish off, Tom, this has been a lot of fun, as always. Talk to us about, when you're thinking of these model portfolios that you're putting together, you don't have to give us all the secret sauce, but can you talk a little bit about your stock selection approach? Like, how do you identify opportunities? Is it a sort of top-down macro, here's the interest rate environment, here's where things are headed, these are the types of names that should do well? Is it more bottoms up, looking for individual names beating earnings or with good setups? Is it a combination? Like, how do you sort of go from what you're seeing on these long-term charts to actionable ideas and sort of putting them to practice?
Well, whenever we do I call them portfolio drafts, because literally we have the top picks in the draft. It's like being in the NFL, being a general manager, and somebody says, here, pick the top 10. You get picks 1 through 10. You could build a pretty good team in theory if you had the top 10 picks.
You get the whole first round when you're doing this, right?
Yeah, you got to stay away from Ohio State and those Buckeyes, but other than that.
We almost made it through the whole show, Tom. Come on.
I had to throw that in. You knew it was coming. I haven't talked at all about the Cleveland Browns, so we're good. We're still friends.
That is, we signed an agreement that is off topic. All right, we can't go there.
Anyway, getting back to your question. So yeah, I mean, I think about the themes first, and when we do these
Yeah.
portfolio drafts, it's actually an event at Earnings Beat. So I go in, I talk about the things that we're expecting over the next few months, and so that kind of starts the wheels turning as far as which stocks you might want to get into.
Yeah.
And then also we keep what we call a strong earnings chart list. So it's a watch list, but right now it's got 450 companies on it that all beat Wall Street consensus estimates as to both revenues and earnings in the last quarter.
Mm.
And every one of our portfolio stocks since 2018 has come off of this list. So, I mean, think about it. If you're talking to management says, "Hey, this is what we're expecting in terms of revenues," or the analysts as a whole just talk to management and they get that feeling that this is what we're expecting for revenues, this is what we're expecting for earnings per share, and then companies come out and miss those numbers. It's like, well, not really executing at a great, not doing a great job at your job. And then especially those management teams that can't beat in the current quarter, but then raise guidance in the next quarter. And to
Mm.
me, that's just a red flag. It's like, wait a minute, you just missed earnings, but I'm supposed to believe that you're going to, do better next quarter or next year. And so we just like to stick with the companies that are executing their business plans. They see their stock going higher. We're momentum traders as well. We're not trying to bottom fish. We're not trying to find that turnaround candidate. We're trying to go with companies that are executing their plan and doing really well and expecting them to continue to do well. And we know going in, they're not all going to do well. But again, the idea is that if we hit 2, 3, 4 of these to do really well, it's going to carry our entire portfolio to the upside. And then we
They
just simply
don't all
reevaluate.
have to be winners, right? But you get a couple of them that can really make the difference, right?
Right.
It's you remind me in my Fidelity days, we'd always talk about looking for good companies with good charts, and it sounds like with you and the team at Earnings Beat, you've done an incredibly good job at looking at that marriage between the two and having great success with it. Tom, listen, this has been awesome as always. Remind those of us that are watching or are less familiar with your work, where can they find more about you and follow what you're thinking?
Yeah, you can go over to earningsbeats.com. So both plural, earningsbeats.com. We have a free newsletter over there. I'd highly recommend. We have tens of thousands of folks that have signed up for that. There's no credit card required. You can unsubscribe at any time. You're certainly not going to hurt my feelings. But yeah, I mean, it's a free chart and a couple paragraphs that comes out every couple of or twice a week, Mondays and Wednesdays. And I just try to show things and teach things that we use at Earnings Beats and try and incorporate a lot of the themes and strategies and so forth. And we've had a lot of members and non-members who have been members of this or subscribers of this newsletter who say that it's really helped change, their trading and we focus a lot on risk management, reward to risk. You and I, Dave, had a lot of discussions about that, but yeah, I mean, I think the key is entry. Just like I showed on that ALAB chart, getting in on a pullback instead of chasing. I think that those types of strategies can really help individuals quite a bit. And that's what we try to do at Earnings Beats.
Tom, I'm a big fan of you and your work, as hopefully I believe you know, and wish you the great holiday season, and hope we can catch up in the new year. All right.
That sounds good. Thanks so much, Dave. Always a pleasure to join you.
So despite Tom Bowley aggressively throwing my Cleveland Browns and Ohio State Buckeyes under the bus, overall, I thought it was a pretty fun conversation. Tom's a really smart guy, and I love his approach to charting and technical analysis. What I love about talking to someone like Tom, and this has been a theme with a number of my guests, we get so drawn into the short-termism of the markets, what we call the flickering ticks, looking at every day, every print as if it has great meaning. Tom kicks us off looking at some long-term weekly charts going back 20 odd years. But that's the lens with which I think you can make sense of short-term movements because they happen within the context of a much longer trend. I thought his thoughts along those lines were really interesting. I thought toward the end where he was talking about, just stock selection and looking for good companies that have good charts. As I mentioned in my discussion with Tom, this is a technique that I know a lot of big money managers use. In my experience working with big money managers, we would focus on that particular sort of combination. We would back in the day we had what we call a trip aces or the trifecta screen, or the thrice blessed screen, or different names we would have it, which would be when the technical research, fundamental research, and quantitative research disciplines were all agreeing that a particular stock was a good stock. And when all three groups, using their own independent methods, agreed on the potential for a stock, it was sort of a layup, right? You had to take a swing at it. So I thought Tom's comments about how to combine really fundamental and technical analysis, looking at earnings growth and price appreciation, I think was really well said. And I hope that's something that resonates for all of you. Really enjoying putting these conversations together. I really have I have great pleasure in sitting down with people like Tom. I'd love to sit down with others. If there are other people that you think would be good interviewees for the Market Misbehavior podcast, make sure you drop a comment here on our YouTube channel and let me know. Happy to reach out to people. A couple of the guests we've had so far have been from people like you making a recommendation. So I'm open to anybody. Please let me know who you think would be good to reach out to. Also, as a reminder, if you like this sort of thinking about technical analysis, combining with other disciplines, about analyzing charts and improving your market awareness by reflecting on how the charts are evolving and how they're changing, our free behavioral investing course could be a great next step for you on your own journey of investing growth. You can go to marketmisbehavior.com/free course, or just scan the QR code that you see on your screen there. Would love to have you there. Join many others who have successfully gone through that course. People have told me it has helped them think about how they think about the markets. And I hope that you get the same result as well. For Market Misbehavior, I'm Dave Keller. And remember, it's always a good time to own good charts. Take care.